Thanks a lot, Chrissy. Appreciate it. And welcome to this afternoon's webinar. It's a beautiful day here in Charlotte, North Carolina. The sun is shining after the hurricane weather came through yesterday. So hope things are looking good wherever you're joining us from this afternoon. This webinar is going to cover financial reporting implications of COVID-19 for not-for-profit organizations. And I am joined today by my partner in crime, Roselle Benoit. Roselle is the technical leader of our not-for-profit industry group, and I am the industry practice leader for the not-for-profit industry group. And Roselle, right as we get started here, you know, with so much new information coming out on coronavirus all the time, in an abundance of caution, I decided, why not just throw a couple of virtual masks on us, just in case this stuff spreads through webinars now. You never know. So we got our masks on, we're ready to go, and we've got so much to cover today that I think we'll just we'll dive right into the agenda. So appreciate everyone joining us. This agenda is really going to split into three parts. The first part, we're going to talk about just some refreshers on some general financial reporting considerations that we're getting frequent questions on, or that sort of impact the financial situations that arise when you're dealing with something like a pandemic. So just some general items. The meat of our webinar today is really going to be in this middle section, talking about accounting and audit issues related to stimulus funds, which a lot of our not-for-profits have received. And then we're going to have probably the shortest FASB update in the history of FASB updates will be the way we round out the presentation today, with just a couple of quick reminders on some of the delays that are out there and some of the things that are still effective for this fiscal year that you may need to implement. So with that being said, we're going to jump right into our first polling question. So the first polling question out there is, we want to know, what type of CARES Act stimulus did your organization utilize? We've got PPP loans, the higher education emergency relief. Some of our healthcare organizations may have got some provider relief funds. You may be taking advantage of maybe the tax credits or some of the tax deferrals. And if you received multiple, then maybe just pick the one that has the highest dollar value or impact on your organization. And if you received none at all, we want to know that too. So we'll see what's coming in here. Lots of people are responding. We have about close to 90% of the vote in. So if you can select your option, we got about 91% of you who have clicked on one of these. And as Chrissy finalizes the poll results, it looks like the vast majority of folks, no surprise here, about 56% received a PPP loan. We've got some higher ed clients definitely on the webinar today. About 16% got those higher ed relief fundings, 5% with the HHS provider relief funding, and about 7%, if you couldn't take advantage of some of those, might be taking credit of maybe the employee retention credit or some of those deferrals. And then this poor 16% that didn't get anything. I feel sorry for you. Hopefully, there's one more round, it sounds like, coming out here. So hopefully you're able to utilize something from Congress in the next round of stimulus.
Matthew, let's hope that the 16% means they're in good shape and didn't need any.
Or that could be the case too. Yep, declined it all because we didn't even need any. So there you go. So let's jump into the general financial reporting considerations. And again, these are just kind of things that might kind of impact industry-wide, someone within the not-for-profits. And the first thing is really thinking about some of the estimates that we have that might be impacted by COVID. So we know that anytime you have a recession and this kind of volatility and an unusual environment we're in, you've got customers that may be paying slower. You've got donors who maybe don't want to pull funds out of the market and are dealing with liquidity issues. So we think this year in particular is a year that you want to focus on on any allowances around collectability of receivables, whether those be from customers or from donors. And certainly, if you think that those receivables are still valid, one of the things your auditors may be asking you for is documentation of those conversations with customers, whether that's parents, students, or donors, of just kind of what the status of their receivable is, and maybe when they plan to make payment on that. Other general estimates that might be impacted, certainly fair value of investments, particularly those that do not have readily determinable fair market values. So those level 3 investments where you're relying on a third party to make judgments, certainly encourage a higher level of scrutiny around those. And then I also put up here loss contingencies. Unfortunately, in an environment like we're in, that's got such a broad impact on the economy, people tend to become very litigious in this environment, and we've seen lawsuits, class action, and others arising in the education sector, and we know that people get a little quick to get litigious. So if there's any loss contingencies that need to be considered, certainly you would want to evaluate those with your auditors and your legal counsel regarding any loss contingencies that would need to be recorded or disclosed. Moving on, this is a subject matter that we haven't had to visit really in a while, but it may be something that you have to consider for this year, and that's really the potential impairment of any long-lived assets you have. So any of your capital sort of PP&E assets, and there likely are to be, anytime there's a recession, there's likely to be more triggering events that would cause you to have to evaluate impairment. So a triggering event would be something like maybe just a significant decrease in the market value of that asset group of long-lived assets. It could be significant adverse changes in the manner in which your assets are being used, or maybe the physical condition of your assets is deteriorating. Or it could be maybe you're expecting to sell off some assets to generate liquidity. So maybe you have a sale pending, or you're thinking about otherwise disposing assets to generate liquidity. Any of those types of events would be triggering events that would cause you to look at those long-lived assets for impairment. So a quick refresher on impairment accounting for long-lived assets is what we would do is we would take the sum of undiscounted cash flows from the use or eventual disposition of those assets. You would compare that sum of undiscounted cash flows to the carrying value, or the net book value of your assets. And then if the carrying value is greater than the sum of those undiscounted cash flows, you would need to go on to the next step of determining what a fair value for those assets would be. And finally, you're going to recognize an impairment loss if the carrying value or your net book value exceeds whatever that fair value ends up being. So that's how impairment testing and impairment losses gets recognized in a nutshell, and thought that would be just a good little refresher as we go into our fiscal year end. Other general considerations, last year as people implemented the new accounting standard for not-for-profits, we had to create new liquidity and availability disclosures. So certainly any impact that COVID has had on your liquidity position, you would want to consider for updating in that disclosure. And then we know that when market values fluctuate significantly, when there's lost revenue streams, that sometimes that can trip a debt covenant, whether it happens to be a debt coverage ratio or an operating metric type ratio. Sometimes those debt covenants can be tripped in a time when the financial conditions of the organizations are changing rapidly. So just as a reminder, if you do have a debt covenant violation, it's something you'll probably want to get on top of and not wait till the end of the audit process to deal with. Even if you have a covenant violation before the balance sheet date, you'll have to get a waiver, and the waiver has to be for at least 1 year from the balance sheet date. And you're going to have to assess whether it's probable that you might fail that covenant within a year from the balance sheet date as well. So there's a couple of hurdles you have to get over before you can determine that you can continue to present, your long-term debt as long-term debt. Otherwise, if you're in a violation position and those covenants don't go out for at least a year and you don't think you're going to pass them for at least a year, then the debt under GAAP would be shown as current. And if you have any violations that occur after the balance sheet date, of course, you'll want to make your auditors aware of that, and the debt would remain classified as non-current, but you would likely disclose that future violation or potential future violation under GAAP as well. Moving right along, a lot of questions have come in, especially for our 12/31 year ends and the roller coaster ride the markets took in March, April, and May, about market volatility and when do we have to, when should we be disclosing or recording something on our financial statements as the markets go up and down like a roller coaster. So we quickly put this AICPA technical Q&A up here as kind of a reminder of what the guidance is. So a lot of times the question is, in light of overall market declines, should those declines in market value of assets subsequent to the balance sheet date result in adjustment to the financial statements? So if we look at FASB ASC 855-10, paragraph 3, we can see that an entity shall not recognize subsequent events that provide evidence about conditions that did not exist at the balance sheet date, but arose after the balance sheet date, but before the financial statements were available to be issued. So this was a bigger impact for our 12/31 clients who, prior to their audit being issued, were seeing major declines in market value of their investments or endowments. And the question came up, should we record this or disclose this? With the answer being, no, we shouldn't record that. The next question being, should we disclose that at all as a subsequent event? Well, in our experience, most organizations that have general disclosures about market risks and credit risks in their footnote disclosures do not find it necessary to comment on market fluctuations that broadly impact the majority of entities, such as stock market declines. So we don't think it's something you necessarily need to address in your footnote disclosures, but some people want full transparency and choose to include some type of disclosure anyway, and we see nothing wrong with doing so, just not required under GAAP. Speaking of market declines, the other thing we tend to see when we see market volatility is sometimes we see those underwater, those endowments going underwater due to market fluctuations. As a reminder, under the new financial reporting standards, market value declines for endowments that would go underwater are now a required disclosure under GAAP. Underwater endowments are defined as a donor restricted endowment for which the fair value of the fund at the reporting date is less than either the original gift amount or the amount required to be maintained by the donor or by law that extends those donor restrictions. And as a reminder, we used to record those endowment losses in unrestricted net assets, but with the accounting change that was adopted under ASU 2016-14, those endowment losses are now held within the category of with donor restriction. And then up here is just a reminder of what the disclosure requirement is, which is simply a disclosure of the fair value the original gift amount and the total dollar amount of underwater endowments. We often get asked, does that need to be done for any endowment that's underwater, or just if there's a group of endowments underwater in total? And the answer to that is it can be done in total for the cumulative number of endowments that are underwater. All right, moving right along, we get a lot of questions with so many changes that are happening with stimulus funding, with market volatility, with our organization's revenue streams. A lot continues to happen around the year-end dates of our clients, and some things are kind of happening before and after. So it's always a good reminder just to talk about what types of subsequent events there are under GAAP and when those would require us adjusting balances versus those that would require disclosure only. So as a quick refresher, we've got two types of subsequent events. A type 1 subsequent event is any events or transactions that provide additional evidence about conditions that existed at the balance sheet date, including estimates inherent in the process of preparing the financial statements. These are considered recognized subsequent events. So when you have information and conditions that exist as of your balance sheet, and you get more information and clarity on those subsequent to the balance sheet date, those would be recognized in the financial statements. Type 2 is any events that provide evidence about conditions that did not exist at the balance sheet date, but arose subsequent to that date. Generally, those items are disclosed if they meet both of two criteria. The event should have a determinable, significant impact on the balance sheet at the time of occurrence, and without disclosure of it, the financial statements would be misleading to the users. So it's got to have both a significant effect, and you would think it would be misleading not to mention that this event occurred subsequent to the balance sheet date. And that's what ended up happening with a lot of disclosures that were generally focused on the impacts of COVID-19 for the 12/31 year-end clients, where those conditions did not exist as of the balance sheet date, but arose subsequently. And then this slide just presents, if you do have a type 2 event, what are the disclosure requirements? Well, really a description of the nature of the event, any estimate of the effect it would have on the financial statements, and in very rare instances, you would actually provide pro forma financial reporting that would show the effects on the financial statement had that event been recorded as of the end of the reporting period. All right, one subject matter that has come up on several of our audits, unfortunately, is the issue of going concern. And of course, there was a new ASU that really placed more emphasis on going concern within GAAP, as opposed to the old methodology, which played more of the onus on the auditors to evaluate going concern. So really under current GAAP, in connection with preparing financial statements for each year, GAAP requires that the organization's management evaluate whether there are conditions or events that raise substantial doubt about the organization's ability to continue as a going concern. This evaluation has to be performed for at least 1 year out from the date the financial statements are issued. Notice I said issued, which is a date subsequent to the fiscal year end of the organization. So you always have to be looking out from 1 year of issuance. With situations changing so frequently with regard to impact on operations, closures, and so forth, determination about the reasonableness of financial projections right now is extremely difficult. So if you find yourself in this situation, it is best to address it right away before your auditors are asking you the questions about your ability to continue and have those financial projections in place. If there is ultimately a liquidity issue or a material impact on the organization, there will likely be an emphasis within the auditor's report about that situation and drawing attention to disclosure of that liquidity issue. And if there ultimately is a going concern, you can pretty much bet that there would be a going concern paragraph within the auditor's report that would describe the situation that's occurring. So hopefully that's not the situation for the folks on the phone, but wanted to go over those refreshers anyway. And then finally, the last thing we mention in kind of our general session is internal controls over financial reporting. Of course, the impacts of COVID have changed the way we are all running our organizations. So we just strongly encourage you to continue to monitor the way in which controls are being done in our new work from home type environment that we're all living in, and whether you need to consider any new controls or reevaluate the way you're doing things. And if you have made changes, to make sure you're updating your current procedures, which may have felt temporary at the time being, but might become more permanent. Make sure that you're updating those within your control narratives and documentation for your auditors as well. So that wraps up the first portion, and we're going to open up our next polling question going into our stimulus portion, and that is, which revenue streams have been most impacted by COVID-19 at your organization? So has program revenue been impacted? Is it more on the gifts and contribution side that you're seeing an impact? Maybe you're an organization that receives a little bit more of your funding from federal, state, or local grants and contracts. If you're a private foundation or one that relies on investment income, that might be your biggest impact. Or if you're one of the lucky few, maybe it's the same 16%, Roselle, that didn't take any stimulus. Maybe this just really hasn't had a significant impact. So we've got about 80% of the vote in. We're just waiting on a few more. And as the last few people get their votes in, looks like the numbers are kind of settling in here. And we got obviously the most impact being program revenues. So really our revenues probably that are coming from, customers, members, the actual programs that we have at our organization. A little less than that, about 17% got hit hardest in their contributions and grants, or contributions and gifts, about 8% in grants and contracts. And then we kind of have a tie there for third place, about 11% with no impact. That's really good to hear. And about 11% with investment income being their highest impact. So that rounds out, and we're going to go into the next section, which Roselle's going to kick us off talking about stimulus.
All right, so now we're going to pivot and talk about how to account for all the stimulus funds. But first, let's talk about what is and what is not going to be subject to your single audit this year. So right now, the 2020 compliance supplement, which is what the auditors will be using to determine, what they need to test and the extensiveness of their tests, has not been issued yet. Hopefully that will be issued soon. We've been told that it's going to be issued in two parts. The first part will have all of the programs that have been in there before, and then there will be another compliance supplement that will be issued kind of in the fall that will cover the CARES Act funds. So this will be kind of like last year, where there will be two compliance supplements issued. And both of these will be effective for audits of the fiscal year ending after June 30th, 2019. So the ASCPA and the GAC have issued a little guidance as far as what is subject to the single audit. So the higher education emergency relief funds, the Provider Relief Fund, the Economic Injury Disaster Loan Fund. All three of these are subject to the single audit. The federal agencies that are governing each of those for the HEERF funds is the Department of Ed. For the EIDL loans, it's the Small Business Administration, and then for the provider relief, it's the HHS. And none of them have really come out yet with guidance as far as what specifically is going to be required to be tested. Hopefully we'll hear some of that soon. They've also stated that the PPP loan, although it does have a CFDA number, that it is not going to be subject to the single audit. So if all you received was a PPP loan, it won't be subject to the single audit. And you know, I know a lot of not-for-profits were concerned about that because it may be that the PPP loan put them in a position where they might have to do a single audit, which they haven't necessarily done before. So you're in the clear if all you have is the PPP loan. The SBA has stated that all PPP loans in excess of $2 million will be subject to review, but there really hasn't been a whole lot of guidance as far as the logistics and timing of all of that. And you know, they may kind of change some of that or change that statement. So stay tuned on that as well. So the next thing we wanted to just talk about are the types of stimulus that we're going to go over. So primarily what we're going to talk about today are the HEERF funds, the PPP loan, Provider Relief Fund, and then the employer tax deferrals, and then the employer payroll tax credit. Those are the ones that we've seen kind of most not-for-profits have received, you know, at least one, if not a variety of these funds. Before we do that, though, we're going to do a quick recap on ASU 2018-8, or which is also referred to as ASC 958-605, which is its codification place. So, and this would be the technical name for it is clarifying the scope and accounting guidance for contributions received and made. Remember, this was issued in conjunction with ASC 606, and the goal was to really help clarify when a transaction is considered an exchange transaction and when it's considered a non-exchange transaction. Both, you know, 606 and ASU 2018-8 were supposed to be adopted this year. However, you know, as part of its kind of COVID relief efforts, the FASB decided to defer the adoption of 606. So if you are, the guidance was issued, I guess, in early June. So if you've issued your financial statements after, you know, the guidance, you can defer your 606 adoption if you so choose. But FASB decided not to defer the adoption of ASU 2018-8 because they really felt like this guidance would be helpful for not-for-profits, help them to account for these stimulus funds. So they decided not to defer this one. So under ASU 2018-8, contribution and grants revenue are considered conditional contributions and therefore deferred if the funds include both a barrier that must be overcome before the recipient is entitled to those assets, and a right of return or right of release to the donor if the recipient fails to overcome those barriers. So the next slide, we're going to talk a little bit about kind of the indicators of a barrier. Thank you, Vanna, for switching the slide. So the guidance includes a list of kind of 3 indicators that may be helpful in determining whether an agreement contains a barrier. The first indicator of a barrier would be a measurable performance barrier. So this would be a type of barrier where an agreement is contingent upon the achievement of a certain level of service, or perhaps an identified number of units of output or a specific outcome. The second one is a stipulation that limits discretion by the recipient on the conduct of an activity. So an example of this type of barrier would be, you know, an agreement with a requirement to follow specific guidelines about qualifying allowed expenses. if you had a requirement to hire specific individuals as part of the workforce that are conducting the activity, or if there was some sort of specific protocol that must be adhered to as part of the agreement. And this is really where you would see a lot of your federal grants would kind of fall into this category. And then the third indicator of a barrier would be, if you saw stipulations that are related to the purpose of the agreement. So an example of this would be like an agreement for, say, an animal shelter to expand its facilities to accommodate a specified number of additional animals. That might be an example of this barrier. So when you're looking at your agreements, you kind of want to keep these in mind and read and see if you have any of these barriers. So keeping those in mind, now we're going to kind of talk about the various stimulus funds and the accounting for those specific ones. So the first one we're going to talk about is the Higher Education Emergency Relief Funds, or HEERF. So the HEERF funds do contain some barriers and also kind of an implied right of return that's really inherent in just about all federal funds that fall under uniform guidance. So per the HEERF legislation, at least 50% of these funds must be granted to students to help cover expenses related to the disruption of campus operations due to the coronavirus. And this could be anything from food, housing, course materials, technology, healthcare, and childcare expenses. And then the remaining portion, up to 50% of the full grant, should be used by institutions to cover costs associated with significant changes to the delivery of the instruction due to the coronavirus. So this would include, reimbursement for foregone revenue due to refunds made to students for room and board, as well as, additional new expenses related to the closure. Now, both the student portion and the institutional portion are considered restricted funds, and would be recorded as deferred revenue until those barriers are overcome. Another thing to kind of keep in mind is, since the institutional portion should be no more than 50% of the student portion, you really want to make sure that the institutional portion, any revenue that's recognized from that, does not exceed the amount of revenue that's been recognized for the student portion. And then finally, the expenses for the HEERF funds provided to the students should be included in scholarship and fellowship expense on your statement of activities, and shouldn't be netted against your tuition discount amount. So, and then also, if you include an operating measure in your statement of activities, both the HEERF related revenue and expenses should be included in your operating activities. So all of these grant related revenue and expenses are going to be above the line. So next we're going to talk about the Payroll Protection Program. And for not-for-profits, there's a couple of different options for how you can account for this. So you could either follow ASC 470, which is the accounting guidance for debt, or ASC 958-605, which is the guidance for contributions and grants. So if you decided to follow ASC 470, then your PPP loan is recorded as debt, and you're going to be, accruing interest expense related to that debt. One thing to keep in mind too that we wanted to make sure to point out, usually when a not-for-profit receives a below market interest rate, so keep in mind, I think that the interest rate for the PPP loans was 1%, so which is arguably below market. You're required to record the difference as contribution revenue. However, the interest expense on the PPP loans falls under exception in GAAP for government mandated interest rates, which basically says that if it's a government mandated interest rate, you don't need to record revenue for the difference between the market rate and the below market rate. So if you followed ASC 958-605, then your PPP loan is accounted for as if it was grant revenue. And since the forgiveness is considered conditional, then your loan would be recorded as deferred revenue when received. And we're going to talk a little bit later about, you know, some of the nuances as far as when you would recognize that as revenue, but initially you'd be recording it as deferred revenue. So a little bit more about the PPP loan. So again, as we said, contribution and grant revenue is deferred. And really the language that you want to be focusing on is that it's considered deferred revenue until such time that all the conditions have been substantially met or explicitly waived by the donor or grantor. The definition of substantially met can vary, but at a minimum, it's probably after you've kind of gone through your loan forgiveness calculation analysis and made sure that, you know, you've got the expense, the payroll expense, and the FTE requirements have been met. And that would really be kind of at the point that you might consider recognizing it. And we've got a couple of scenarios that Matthew's going to go over and talk a little bit about the accounting treatment for those next.
Thanks, Roselle. And, you know, we thought for purposes of this, we know we're going to get a lot of questions around how and when do I recognize my PPP loan forgiveness? So what we've tried to do here is really, we came up with a couple different scenarios that we think are probably the most common scenarios among not-for-profits, but we know that fiscal year ends are different. Some people have 5/30 year ends. Some people have 9/30 year ends, 6/30. So the situation may be a little bit different for everyone depending on your year end, but we tried to pick a couple of scenarios that we think are most highly applicable to not-for-profits. So let's take this scenario number one of a PPP loan where you maybe were one of the ones that were early to apply for a PPP loan and got granted your loan. In this scenario, you have your initial 8-week period, assuming you're not looking to the 24 weeks, that ended within your organization's fiscal year end. So maybe your 8 weeks was up before 6/30 or maybe a few days afterwards. And you've incurred enough costs within fiscal year end 6/30 to get, you know, full or maybe close to full forgiveness. You're on top of your forgiveness application. You've already evaluated expense and detailed to be going on your application when it becomes available, and the banks start accepting them. And you know kind of what your FTE levels did. So you know about any adjustments that might need to be made for FTE levels. And of course, you probably meet the more than 60% expenses related to payroll and benefits threshold. So if that's kind of trending towards your situation, here would be kind of the accounting options under that scenario. So if you decide that, you know, we really think this is a loan, we're going to record it like a loan, and we're going to use ASC 470, then obviously this would go on your books just like any other piece of debt would. It would be reported as a loan. You would, of course, accrue your interest expense through your fiscal year end date. And then maybe depending on your situation, I know some organizations are still treating this as a loan and plan to repay it before it's due. Others are planning on applying for forgiveness eventually. So in this case, you would not recognize any revenue or forgiveness until the subsequent period when you actually go through that process and get your actual forgiveness from the lender, from the SBA in that scenario. If you were to look at this more like a grant or contribution from the federal government, then you would use ASC 958-605, and likely under that fact pattern that we described in scenario one, we believe grant revenue could be recognized as of 6/30 year end. In other words, probably the fact patterns would be one that you could conclude as management that you've substantially met the conditions on which you needed to do to meet forgiveness for that role. But, and there's always a but, you really could choose to defer that recognition of that revenue for forgiveness until you actually get the formal forgiveness from the lender and the SBA. And that's where there's a lot of variation right now in guidance and perspectives that are out there, is coming back to this definition of when are these conditions substantially met. And we believe there's enough flexibility under GAAP that could lead one organization to decide they have substantially met the conditions as of 6/30 and recognize it, while another organization could have a very similar fact pattern and say, you know, maybe our loan's over $2 million. We still have to go through this audit. We don't know what that's going to look like. And you could reasonably determine that you haven't substantially met the conditions until you actually receive forgiveness from the lender. And that's perfectly fine to go down that way as well. So I hate having gray areas in GAAP where it's not just black and white, but so much of GAAP is like that. And this is just one scenario which we think you likely have a position to recognize the forgiveness in your current fiscal year, but could continue to defer it if you feel uncertain that you've substantially met all the criteria. In our scenario number 2, which is probably going to be a similar situation for a lot of organizations, is so you've received a PPP loan prior to your fiscal year end. You're planning to use every bit of time you can get to incur the expenses needed to get full forgiveness. So you're heading towards that 24-week. And maybe you haven't even started, since you're just accumulating expenses still subsequent to year end, you haven't even started really analyzing what your forgiveness application will look like. So we know that there's going to be a number of organizations that fall into that category. So under scenario number 2, the treatment under ASC 470 is the exact same. So if you're going to go the route of using ASC 470 and treating this like any other piece of debt, then you're going to report it as a loan, accrue the interest, and you wouldn't recognize the forgiveness until you actually get the forgiveness formally. If you're going to look at this under ASC 958-605, you would likely recognize this not as a loan on your balance sheet, but as a deferred grant revenue, assuming that you're planning on applying for forgiveness when you've accumulated enough costs in the subsequent fiscal year to be able to get your forgiveness of the loan. So in that case, you've got deferred grant revenue on your books, and you're probably looking at your next fiscal year to recognize this. So, and then of course, the SBA will allow you to apply for forgiveness at any point in between the 8 and 24 weeks. So, you know, everybody's situation could be a little bit different, but your recognition really comes back to that moment where you believe all the conditions are substantially met. So if that doesn't exist as of 6/30, and certainly if you're continuing to need to generate expenditures to apply for forgiveness, then it probably should be deferred until the next fiscal year. So hopefully those 2 scenarios provide a little bit more clarity. Hopefully they don't make the water any milkier, but that's where we think things are kind of trending with the GAAP options for PPP. So moving right along, I know there's some questions out there on PPP. We'll try to get to those in just a moment. I wanted to talk briefly about provider relief funds as well. So the provider relief funds are from HHS, and you may have been a recipient. I think there was a number of people on the webinar that received those funds, probably from the initial $30 billion payment that went out to Medicare providers. And honestly, the recognition of these grant revenues is going to follow the similar accounting guidance that we've been talking about all along. So you're going to follow the accounting guidance for contributions. And again, you're going to recognize you may have received these provider relief funds up front and you're already sitting on the cash, but we should not be recognizing that as grant revenue until the conditions have been substantially met to incur the qualifying expenditures under the terms and conditions of the Provider Relief Fund program. And of course, those expenses have to be attributable to the coronavirus. They have to be healthcare related expenses to prevent, prepare for, or respond to the coronavirus, and can also include lost revenues. And I haven't seen a lot out there as far as how exactly organizations are going to calculate that figure for lost revenues. Certainly, we haven't seen what the audit procedures will be around auditing lost revenue calculations, but we know that there's probably more questions than answers with regard to the provider relief funds right now. But what we do know is that this will trigger some reporting requirements and some single audit requirements for organizations that might not have had a single audit in the past. So we do know that anyone who received relief funds must report within 45 days of the end of their calendar year in 2020 on their expenditures through the period ending December 31st, 2020. If you fully expended your provider relief funds before the end of this year, before December 31st, then you can submit a single audit anytime in the normal window between now and February 15th. If you have not fully expended as of 12/31, then it's likely you're going to have to do a second single audit and submit a final report no later than July 31st of 21. And then we've been told that detailed reporting instructions are being prepared currently and are expected to be issued by August 17th, but we have not seen anything. So there's a lot more to come out in that. The revenue recognition is fairly straightforward as far as when you time that, but some of the reporting requirements and single audit procedures are still a big question mark. So with that, Roselle, I'm going to turn it back to you to talk about the tax credits. Are you there, Roselle? Are you on mute?
Sorry, I muted myself and then I couldn't get my mouse to work. All right. Technical difficulties. So if you're a not-for-profit who didn't receive a PPP loan, you may be taking advantage of the employee retention credit and the employer tax payment deferral program. So we just wanted to talk kind of briefly about the accounting treatment for these two items as well. Since the employee retention credit is an actual tax credit, meaning that it's cash savings that you won't have to pay back to the government, this will be recorded as grant revenue at the time that the credit is taken. So reducing the amount of cash that's paid to the federal government for FICA taxes is really just the mechanism for receiving the credit. So for not-for-profits that utilize this, you should be recording the full amount of the FICA expenses. And then the other side of that entry, so your reduction to the liability is going to be a credit to grant revenue, not a credit against FICA expense. So we just wanted to make sure everyone was thinking about it that way. And then for the employer tax payment deferral, this is really just a timing delay on the employer's share of the taxes. So this stimulus item really just has a statement of financial position effect. It's just going to result in a buildup in that payroll tax liability amount until you start making your payments on those deferrals. So so really just a balance sheet effect. So that's those two items. And then we just wanted to quickly list a couple of the resources that we like to look at when we're just looking to see what kind of other entities are putting and what everyone else is saying about CARES Act accounting. So the ACPA, the Government Audit Quality Center is a great resource. Also, they have the Center for Plain English, which also issues some accounting literature. If you're a member of the AICPA not-for-profit section, that also will issue some accounting literature. And then NACUBO has also put out some accounting statements and some literature that I think is helpful. So we just wanted to list those resources so that y'all would know different places where you could get some additional information. And then I think, Matthew, we have another polling question.
We do. We have another polling questions. So this one's kind of forward-looking. What concerns do you have right now regarding the continued impact of COVID-19 on your organization over the following year? So is it mostly related to revenue sustainability and growth, impact on employees, kind of all these compliance and regulatory issues that are creeping up? Maybe you're having to reduce or eliminate programs, or maybe you just are one of those organizations that just hasn't been impacted, and there's no big COVID concerns for your operations. So probably only a few in that category, but we decided to put that in there just in case. So make sure to answer that polling question. In order to get your CPE credit, we want to make sure that everybody has a chance to click on that button. Maybe you were off grabbing a coffee real quick or a LaCroix, and you're rushing back to your computer right now to answer this polling question. Whatever your situation is, we got about 90% of you who have clicked on the polling question, which is pretty good. So we'll close it out there. Not surprising here, Roselle, for me, I think most people just revenue stream, sustainability, and continued growth of the organization, and a strong second place impact on employees too, which is certainly something I worry about at our own organization, just operating in this new environment as well. And then followed up by reducing or eliminating programs, and the other categories were a bit more negligible. So appreciate everybody's feedback on that question. And we are just heading into the final portion of this webinar, which is really just to kind of update everybody on current status of FASB pronouncement delays and what's effective this year. So Roselle, what do we got?
So as Matthew mentioned, the fastest FASB update ever. So as we mentioned previously, this is the standard ASU 2020-05, which deferred the implementation of 606 for a year. And in addition to that, it also deferred the lease accounting standard for 1 more year if you're a conduit debt obligor, and 2 more years if you're anybody else. So good news. As far as 606, there's nothing that says that if you had already done a lot of the legwork and were ready to adopt the new revenue recognition standard, that it doesn't preclude you from doing that. So by all means, if you want to, go ahead, but it also gives you the option to kick it to next year. So that's ASU 2020-05, and then there were a couple of other ones that will have to be adopted this year. So ASU 2018-8, we already mentioned this. This is the new kind of contribution and grant accounting standard has to be adopted. ASU 2016-18, which has just a small tweak to your statement of cash flows. There used to be some disparity between some entities would include the restricted cash with regular cash as kind of the reconciling items at the bottom of the cash flow statement, and then some other entities would be including it in the investing activities. So FASB issued this to get everyone on the same page, and so now it should be included at the bottom with just your regular cash. So that's one item. If you have restricted cash, you want to make sure you're adopting this year. And then the other one is ASU 2017-7. And this one just has some small changes to the presentation of pension and OPEB costs on the statement of activities. So the service costs should be included in the same line item as other compensation costs arising from services rendered by the pertinent employees during the period. So that would be included in your operating activities. And then the other components or expenses related to your net benefit cost should be included separately from those service costs. and would be shown kind of outside of your income from operations if you do present one. So just a small change, again, to try and get everyone kind of on the same page. So if you do have periodic, if you have pension or OPEB costs, you just want to be talking with your auditor to make sure you're classifying that in the proper place on your statement of activities. So that is the FASB update, and I think that gets us to the last polling question.
Yeah, Roselle, one last polling question. We tried to make this one an easy one, not knowing how much time we would have. So was this webinar helpful for your organization? We hope the answer is yes, or at least somewhat. But if it's no, be honest with us, and maybe when you're doing your survey at the end of this course, we really do encourage you to fill out those surveys and just give us feedback on what you'd like to see for next time we get together and do our next not-for-profit webinar. So appreciate that. We've got about 91% of the votes in, and Roselle, I'm happy to report it's an overwhelming yes with 88% so far. 12% was somewhat, and thank goodness 0% with no. So at least you didn't waste an hour of your time with us this afternoon completely. So happy about that. So that brings us to our questions slide. We have been doing a good job keeping up with questions. Chrissy, we've got one person. If they missed a polling question, Chrissy, what do they do? Is there a way to contact you and say I was there, I just missed it, or what's the deal there?
If they missed one, that's okay. As long as they answered at least 3 of the 4, they'll be okay. So if they miss one, they're safe.
All right, well, that's good news. And then we have one last question here that I believe there's only one question that we haven't answered from the questions pod. Feel free to ask one. We have a few more minutes. But somebody's asking, would any of the Families First Stimulus Act money, wages paid by the government, be treated the same way as the employee? It says tax deferrals, but I'm guessing you meant the employer retention credits, the tax credits, i.e. as a contribution. Roselle, you let me know what you think about that. I think that yes, it would be treated the same way, that the credit is simply the mechanism of the federal government getting the stimulus to you. It is a credit on your 941, but the money really isn't a reduction of that expense. It should be, the expense should be recorded in full, and you would record the credit as a revenue, as a grant revenue or a contribution revenue.
Yeah, I would agree with that. And the other thing that I didn't mention is when y'all are working on your statement of activities, you may want to think about, just depending on the dollar amount of all the various stimulus fund revenue items, just for comparability purposes, maybe breaking it into a separate line item from your other kind of contracts and grants. So just, as you're doing these, you may want to be talking to your auditor about just making sure that some of these items are specifically kind of highlighted on your statement of financial position and statement of activities for comparability purposes. Definitely, I think if your PPP loan is deferred revenue, I'd separately, show that separately on your statement of financial position, just to separate that from your normal deferred revenue.
Thanks, Roselle. Just one or two more questions with our last minute here. Somebody asked if I had a dad joke, and actually I just heard one. Chrissy just told one as we were preparing to hop on the webinar, and that is, I've got a coronavirus joke for you. And I don't know, Roselle, is somebody you would say, what is it? And I bet you won't get it. I bet you won't get it, Roselle.
Yeah, I don't think I get your joke.
The setup was not right. So the crux of the joke is, I bet you won't get coronavirus, obviously, but I bet you won't get the joke. So I could have delivered that better, but wasn't my joke. When do we expect forgiveness guidance paperwork to be available and final? I don't know. That's probably a question for your lender. Ask your bank. Every bank seems to be on a little bit different timeline, but I have not heard. I just know that it's quite the process. So I would reach out to your lender about that. And we've a few more questions got popped in. We'll try to get back to you offline if we didn't get to you, but we are right at 3 o'clock. So being respectful of our hour together, I think we're going to end it there. And again, thank you for participating with us in this NFP webinar. And remember to respond to that survey real quick if you get a chance. And yeah, we will see you next time. So thank you.
Yes, thanks everybody for joining us today. Just to close out, you will receive your certificate of completion as long as you participated in those polling questions. As long as you answered at least 3 of those 4 polls, you will receive your certificate of completion by email in about 2 to 3 weeks. So thanks everyone for joining. Have a great day.